One of my biggest struggles as an aspiring dividend investor is the difficulty of selecting high-yielding stocks that are also good long-term investments. The more I try to research, the more I realize how difficult it is to successfully pick stocks that will beat the market over long-term periods. And that's why 70% of professional fund managers fail to beat the market annually, and 90% of them fail over a 10-year period. If financial professionals can't consistently beat the market by stock picking, it's pretty safe to assume that I won't be able to either. So while I haven't ruled out individual stocks altogether, lately I've turned to ETFs to secure stable, high dividend payouts without compromising on long-term potential. In this video, I'm going to show you my methodology for finding the best dividend ETFs and two specific ETFs that I've decided to use for dividend investing. This combo is looking at an estimated dividend yield of over 5% with historical growth of nearly 8% annually, so stick around. Before we get into things, if you're new to the idea of dividend investing, you might want to check out the video where I explain some of the nuances of dividend investing and why it's a strategy that I'm personally pursuing. It's become a pretty popular strategy lately, but I think there's still some misconceptions about it out there, so you should definitely take a closer look before you decide to commit to this strategy. But let me explain what I've been going through lately that led me to look at an ETF dividend investing strategy. I've spent hours and hours looking into dividend paying stocks in order to find above average dividend yields. And I really don't have a good metric for this other than the fact that I'm greedy and I wanted to build a portfolio that yields above 4%. The problem is, a lot of these bread and butter blue chip dividend stocks like Johnson & Johnson, Coca-Cola, and 3M have pretty average yields of about 3%, and these are at the higher end. So as I dug deeper and got more exclusive with my dividend stock selection, I came across stocks like AT&T, IBM, and AbbVie, which fit the dividend yield profile that I was looking for. But at the same time, I've continued to do research into the overall market, and there's so much data that shows the S&P 500 is the safest choice for securing competitive annual returns. So while I've continued to invest in some of these higher yielding stocks, I can't shake the idea that I need to be diversifying into more of the market to ensure that I don't miss out on returns over the next several years. But since the average dividend yield of the S&P 500 is only about 2% in recent years, I wanted to find a more aggressive option when it comes to dividends. And that's when I started to look into dividend paying ETFs. The problem is there are hundreds of dividend paying ETFs to choose from. Since it would take months for me to analyze every dividend paying ETF on the market, I used an ETF screener at etfdb.com to find the ETFs that met my strict criteria. So I'll walk you through the metrics that I use to rule out most of these ETFs and my reasoning behind them. Keep in mind that these metrics just fit my personal investment goals and beliefs, so they won't provide the perfect solution for every investor. But hopefully by showing you my process, you'll be able to tweak it and find the best ETFs for your investing strategy if you don't agree with the ones I've picked. So for starters, since I'm looking for a dividend yield of at least 4%, I'll use this as one of my first screening metrics. But I know I'm also going to be paying taxes on these dividends, so I'm actually going to use 4.75% as my minimum dividend yield. This assumes my dividends will be qualified dividends, and they will therefore be taxed at the 15% capital gains tax rate based on my tax bracket. So after paying taxes on that 4.75% yield, I would be left with just over 4%. And also, since I want to lock in that qualified dividend tax rate, I'm going to limit my ETF search to ETFs that only include US-based stocks. This is because dividends from foreign companies generally aren't qualified dividends. The next concern I have is diversification. The whole reason I'm pursuing dividend ETFs is to diversify my investments, so I want to make sure the ETF I choose satisfies that need. Now there's a lot of debate over how many stocks are required to be truly diversified. A study published in 1987 suggested that a minimum of 30 stocks creates sufficient diversification. A study published in 2001 suggests that a 50 stock portfolio will provide adequate diversification. And most recently in 2007, a study claimed that a 100 stock portfolio gives you a 96% chance of financial success. Any of these numbers will give me more diversification than I've got now, so I'm not too concerned with having a ton of stocks in my dividend ETF. I'm more concerned that the ETF is diversified into stocks from different industries, which is something we'll look into further down the line. So for now, I'll just use 30 for the minimum number of holdings. Next is a big one, and this is expenses. ETF expenses are expressed as a percentage, and it's the amount of your portfolio that the ETF issuer is going to collect annually for managing your assets. A study by NerdWallet looked at the cost of management fees over the long term and found that a 1% fee costs the average investor over $500,000 over a 40-year period. The more complicated ETFs get, the higher these fees will be. Obviously, you can decide how much of a fee you're willing to settle for, but I'm going to limit my fees at 0.5%. This will theoretically save me about $250,000 over a 40-year period. Ideally, I'd like to pay even less in fees, but this is something that we can come back to later when narrowing down our options. We're also going to rule out any actively managed funds. Like I said earlier, 90% of fund managers fail to beat the market, and they also tend to have higher management fees. So I'll trust the market and the lower expense ratios of passively managed funds. At this point, we've whittled our options down from 2,314 ETFs to just 17 ETFs. But the screener failed to rule out some of the ETFs that are focused on specific sectors like energy. This sector is known to have higher dividend payouts, but coming back to the idea of diversification, this isn't going to work for me. So I'm ruling out some of these specialized ETFs and a few of the stragglers that didn't get screened out for including international businesses. So now we're down to just 7 ETFs that meet my goals for dividend investing. So to narrow it down further, I'm going to introduce another aspect to my dividend investing strategy that I'd like to consider. And this is the growth potential of the assets in the ETF. One of the most attractive parts of dividend investing is the snowballing or compounding effect of dividend reinvesting. This is where you collect your dividends and reinvest them into your portfolio. If the stocks you reinvest into continue to grow and continue to increase their dividends, you'll gradually build wealth faster and faster. The problem is, not a lot of stocks both appreciate in value and increase their dividends. In fact, many high dividend paying stocks are either stagnant or decreasing in price over time. So in order to achieve the dividend growth that I want from a dividend ETF, I need to make sure the underlying stocks are capable of achieving that growth. Since the remaining ETFs are all passively managed, they're all using a predetermined methodology for selecting and weighting the stocks in their portfolios. So what I want to see is that these methodologies have been effective in driving both capital appreciation and dividend growth in the past. Now I know past performance is no guarantee of future returns, but I think this will be the quickest way to assess whether the underlying funds will at least somewhat mimic the trends of the total market. The S&P 500 has performed pretty consistently over the last 10 years, so I'll be comparing the growth here to that of the remaining ETFs. So let's take a look at the 10-year charts of these 7 ETFs. First, we have SPHD, the Invesco Small Cap, High Dividend, Low Volatility ETF. It's got a dividend yield of 8.5%. Unfortunately, it's only been around for 3 years, and as you can see by the chart, it struggled to achieve any capital growth during that time. Small cap stocks simply won't offer the stability and sustainability of dividend growth that larger companies can offer, so we're going to rule this one out. Next, we've got DIV, the Global X Super Dividend ETF, with a huge dividend yield of 10.5%. Again, coronavirus aside, the chart shows that this ETF has actually lost value since its inception in 2013, a time period where the S&P 500 has achieved a nearly 100% price increase. This is just another example that dividends aren't everything. Yes, you're getting 10% dividend payouts, but your investment is not increasing in value. This may be suitable for a retiree looking to live off of their investment, but not for me as someone who wants to grow their wealth while also collecting dividends. So DIV is out. Next is SPDV. This so-called high dividend value ETF is a newer ETF created in 2017 and currently offering about a 5% dividend yield. It aims to invest in undervalued stocks that have high dividend yields, and it looks pretty well diversified across various industries. Being so new, I don't want to put too much weight in their disappointing price history. However, I think it's important to note that most ETFs that follow a value investing methodology tend to underperform compared to growth strategies and the overall market. Furthermore, the dividends from this ETF are taxed as income, not as capital gains. Based on these tax consequences and its uncertain performance, I'm ruling this one out. Now this is where things get interesting because we have just 4 ETFs left, and all of their charts are at least trending upwards. We've got FDL, the First Trust Morningstar Dividend Leaders ETF with a 5% dividend yield and a 0.45% expense ratio. We've got RDIV, the Invesco Ultra Dividend Revenue ETF with a 6.4% yield and a 0.39% expense ratio. We've got SPYD, the Spider High Dividend ETF with a 5.5% yield and a very attractive 0.07% expense ratio. And we've got SPHD, the Invesco High Dividend Low Volatility ETF with a 5.5% yield and a 0.3% expense ratio. I personally think these remaining ETFs are pretty decent options for dividend investors. They check all of the boxes we've wanted. They're qualified dividends with an annual yield over 5%, they have reasonable expense ratios, they all have over 50 different holdings, and the underlying methodologies seem to be selecting growing stocks. But we're going to have to get a little pickier. FDL is the first one I'm going to rule out, and here's why. First, I like the methodology behind FDL. It's focused on large cap companies, it's composed of 100 holdings, and it requires that each company currently offers a higher dividend than it did 5 years ago. But what I don't like is that it's pretty top heavy. Its top 10 holdings make up 60% of its portfolio. This isn't offering as much diversification as I'd like, especially considering that I already own positions in 4 of these stocks. This ETF has the longest track record of our remaining options, but I also don't like that it has the highest expense ratio at 0.45% and the lowest yield at about 5%. Overall, it's not a bad option, but I like our other dividend options better. Next, we're going to rule out RDIV, and here's why. I really want to like this one because it offers the highest yield, but it's also got a significant expense ratio. I also really like its methodology. It uses the S&P 900, giving some exposure to mid-caps. It also excludes the top 5% of companies with the highest payout ratios and the highest dividend yields, which are typically the businesses most likely to be paying out unsustainable dividends and those that are most at risk for dividend cuts. What I don't like is that it's weighted by revenue, so it's invested heaviest into the companies that make the most money. This sounds good in theory, but this results in the fund being heavily weighted into the financial and energy sectors, two industries that are good for income, but that I'm personally not very bullish on in terms of price appreciation. Plus, this is another top-heavy fund with just 10 of the holdings making up 1/2 of the ETF. So if you've made it this far, we're down to the last two dividend ETFs, and they are certainly worthy candidates. Now, SPYD and SPHD are pretty similar in terms of dividend yield and methodology. So let's take a closer look at how these portfolios work so you can determine if you want to invest in either or both of them. So SPHD is the Invesco S&P 500 High Dividend Low Volatility ETF. It tracks the S&P 500 High Dividend Low Volatility Index. This index functions by ranking all of the companies in the S&P 500 by dividend yield. It then takes the 75 highest yielding companies, limiting each industry's representation to a maximum of 10 different stocks. So this helps ensure diversification among different industries and produces a well-rounded group of high-yielding stocks. But there's one more step. Out of these 75 companies, the index selects the 50 least volatile stocks based on their price movements within the last year. Furthermore, each company is then weighted by yield, so more money will go into the higher yielding stocks, and each stock is capped at 3% of the fund's makeup. So this ETF is a great way to get quickly diversified into high-yielding stocks for dividend investors. The unique quality of this fund is its consideration of a stock's volatility. With less volatility, it slightly lessens some of the drops you see from the S&P 500, which you can see by comparing their performance over the last 10 years. So this might be a more desirable option for someone looking to build a more stable or predictable source of passive income. It also pays its dividend monthly, and its dividends have been consistently increasing since its inception. Obviously, when you look at the chart, SPHD has underperformed compared to the S&P 500. I think one of the main causes of this is that it lacks the exposure to non-dividend paying growth stocks like Amazon and Tesla, or low-yielding but growing stocks like Apple, all of which have driven huge growth to the market in recent years. So this kind of goes back to the dividend investing versus growth investing debate, which I've already covered in my video on dividend investing. And our last ETF, SPYD, is the Spider S&P 500 High Dividend ETF. Similar to the SPHD ETF, it starts by ranking all of the companies in the S&P 500 by dividend yield. But it has no other criteria for selecting the stocks held in the fund. It just takes the top 80 stocks by dividend yield. Unlike SPHD, it doesn't cap any stocks inclusion by sector either. So whereas SPHD limits each sector to 10 stocks, the SPYD accepts the top yielding stocks without question. This means it will be slightly biased towards those industries that just tend to have higher dividend yields, like financials and utilities. Then every stock will be given an equal weight in the portfolio, meaning as prices fluctuate, each stock should make up approximately 1 to 1.5% of the total portfolio. SPYD pays a quarterly dividend, and while they've been trending upwards over time, they're definitely a little less consistent than the dividend increases from SPHD. And I think the problem with this comes down to their lack of screening qualities when selecting stocks for the fund. SPHD chooses the least volatile stocks, which means they're probably more likely to maintain their dividends and those higher dividend yields. With SPYD, it just selects the highest yielding stocks at the time, without properly diversifying across different industries. This means it will inevitably be a riskier investment that might bring a risk of dividend cuts or decreases. Plus, each fund only rebalances their holdings twice a year. So if SPYD happens to invest in a bad egg that cuts their dividend, they won't be swapped out for another 6 months, and that could result in a lower yield than expected for a given quarter. On the other hand, SPHD's methodology better protects it from bad eggs and makes it a safer dividend choice. So while SPYD includes more stocks, it's actually less balanced and might be a riskier dividend investing strategy. That said, with a lower cost and a larger portfolio, it slightly outperformed SPHD, but at the cost of slightly increased volatility. SPHD has a slightly higher cost, but I think it's more appropriately diversified and has a safer dividend outlook. Both have limited growth potential compared to the overall market, but still offer a suitable vehicle for capital appreciation by investing in large cap S&P 500 dividend payers, which historically are strong market performers. So ultimately, these two ETFs are very similar, and both are reasonable options for dividend investing with ETFs. Personally, I'll be splitting my dividend ETF investments between these two options, bringing down my costs slightly, increasing my diversification, and hopefully delivering a happy medium of returns between the two. I don't think I've ever gotten this deep into the facts and figures behind an ETF, and if that's not worth a subscribe, I don't know what is. No, really, please subscribe guys, that'll really help me out, and let me know if this video has helped you decide how to approach dividend ETFs, because whether you're going to invest in the ones I talked about or other ETFs out there, I'd be really interested to hear your take on it. In any case, best of luck with your dividend investing, and I hope to see you right back here for my next video next week.